Hey guys, welcome back to the Joyful Investors channel. In our previous videos, we covered how you can get started on dividend investing and the things that you should know before you get started. For those of you who are thinking, okay, I'm ready and prepared to start now, but how do I screen for the good dividend stocks to buy? So today's video is for you. So let's begin. Before I share the 3 metrics for dividend stocks, greatly appreciate an early thumbs up to support the channel and click on the subscribe button to learn more about investing. The first metric you should look at is dividend yield. Dividend yield is obtained by taking the annual dividends per share divided by the price per share, which tells us how much dividends we are receiving relative to the share price of the stock. In general, that would mean to say, as investors, we would like to invest in a stock that has a higher dividend yield. But that's an analysis at a very base level. Why I say that is because a high dividend yield may sometimes occur due to falling share prices, creating a dividend yield trap. Let me explain further by revisiting the formula for dividend yield again. If we look at the formula, when we say we want a higher dividend yield, we're actually logically thinking of getting a higher annual dividend per share so that the resultant dividend yield is higher. Yes, if the high dividend yield is due to a high dividend per share, then that would be favorable for investors. But not to forget that the share price of a stock is also a variable in this formula. So in a situation when share prices decline, the dividend yield can still increase even if the dividend per share stays constant or gets smaller. To illustrate, take a look at Singtel. A similarly high dividend yield of over 6% does not necessarily mean that this is a good investment. In fact, the dividend yield for 2020 had been higher than 2019, but notice that the dividends per share in 2020 was actually lower than in 2019, as the higher dividend yield was due to the falling share prices. Another example, StarHub saw an unusually high dividend yield in 2018 as well, although the dividend per share in 2018 was the same as in 2017. Now, you may ask, is a decline in the share price something to worry about? Yes and no. We would say yes if the decline in share price is due to the worsening of the fundamentals of the company. In this case, you may not even want to be holding the shares of the company anymore. Nonetheless, there are many occasions in the stock markets where the stocks are mispriced due to irrationality and due to manipulation, and not due to a change in the fundamentals of the company. So in those situations, then the falling share prices would not constitute as a dividend yield trap if there is no change to the fundamentals and the dividend payouts are still fairly consistent. Therefore, while investors would generally like to see a high dividend yield and use it as a metric to screen for dividend stocks to invest in, we have to be careful and make sure to analyze further to understand if the dividend yield has been distorted due to share price fluctuations. Well, but not to worry. The next one that I have here can help you to be less susceptible to dividend yield traps and investing in companies which may already have underlying issues in the fundamentals, which is to look at the total returns that you could have gotten if you had invested in the stocks at least 5 years ago. As we have shared in our previous video on getting started on dividend investing, that though generally investors invest in dividend yielding stocks for the dividends, it does not necessarily mean that there will be no or little capital appreciation to enjoy. In fact, if the stock prices are declining over the years, resulting in capital losses for investors, that could signal a red flag that there lies an even bigger problem with the business of the company. Therefore, always check out the stock chart to see the performance of the stock prices over the years to ensure that you don't end up investing in a company which is on a long-term downtrend. Else, the dividends that you collect are not likely to be sufficient to cover your capital losses. If you would like to put some numbers in to get a clearest perspective of things, here is how you can compute. First, find out what is the capital gain or the stock price increase over a period of at least 5 years, and then add on the dividends paid by the company over the same period of time. Next, divide the total returns by the stock price of the company at that time to get a rough gauge of the percentage returns that you would have gotten if you had invested in this stock then. An additional point to take note is that there are some REITs which have more cyclical price movements. For example, Escort Trust and Capital Land Integrated Commercial Trust. So for such REITs, your purchase price would greatly influence the net profitability of your investment in those dividend stocks. Because you may realize that sometimes the dividends you collected are not even sufficient to offset the capital losses that you made. Which is why we have been sharing in our past YouTube videos that knowing when to buy the dividend stocks also matter as well. The last metric is dividends to free cash flow. How it works is this. Say if we have a dividends to free cash flow ratio of 30%, it means that for every $1 of free cash flow that the company generates, it only pays out 30 cents as dividends. Why we need to look at this metric is because other than looking for stocks that give high dividends, we also want the companies to have the ability to distribute stable and consistent dividends. In other words, the sustainability of the dividends distribution over the long term. The rationale behind this metric is quite similar to that of another ratio called the dividend payout ratio, except that we are now working with cash flow instead of net income to give us a better idea of the sustainability of the dividends distribution. Net income is an accounting figure, which means that there are some items that are non-cash, but they are part of deriving the net income figure for a company. To explain in slightly more layman's terms, it means that certain transactions of recording revenue or of recording the expenses do not involve the inflow or the outflow of cash. In addition, the net income figure is generally more easily subjected to accounting manipulations due to the involvement of judgment and estimates. As a result, there could be situations whereby a company earns, say, 1 million net income, but it actually only has $700,000 increase of cash for the year. Hence, using free cash flow will give investors a better idea on whether the company actually has sufficient cash to pay out its dividends on time and whether the dividends distributed are sustainable. An overly high dividends to free cash flow ratio may be unsustainable over the long run as the company would still need to use cash for its business purposes. For example, if a company has a dividend to free cash flow ratio of more than 1, that would signal a red flag as it implies that the company is paying out more cash as dividends than how much it is growing. So never go for stocks that give you high dividends in just 1 or 2 years at the expense of the sustainability of the dividend distribution over the longer term. So these 3 are some of the important metrics that you should know as a dividend investor. Next up, we'll be sharing some of the untold truths of dividend investing in our next video. So do subscribe and turn on the notification bell to stay informed of our next video release. Do also follow us on our Telegram channel as we'll post about dividend stocks such as the Singapore REITs from time to time. See you in the next video.